Welcome back, investors, to Ticker Time News. I'm Adam, and Doordash shares dashed higher after hitting a new 52-week low post-earnings on Friday, where the food delivery giant actually reported solid Q1 results. Maybe because I ordered too much Taco Bell or Chipotle last quarter. I mean, it's a little too convenient, right? But the overall weakness in the stock, at least right now, is mainly due from the broad-based sell-off in the tech sector. I mean, look at the NASDAQ here. It made a new fresh low for the year on Friday. The headline numbers didn't jump off the page. The company posted a larger than expected loss with good revenue upside. Revenue grew 35% to $1.46 billion. Omicron didn't seem to have presented much of an issue, good or bad, which surprised me a little bit. It wasn't even mentioned during the earnings call. Now, since Doordash doesn't provide adjusted EPS, it's important for investors to focus their attention on adjusted EBITDA as the better way to measure profitability. It's a clean adjusted number, and Doordash provides guidance for it too. On that score, Doordash performed well, growing 26% year over year to $54 million, above the high end of its prior guidance of $0 to $50 million. Doordash offered Q2 adjusted EBITDA guidance of $0 to $100 million. Given that warmer months tend to be seasonally weaker for Doordash since fewer people order from home amid good weather, so I view this guidance as pretty solid. Doordash sounds more positive too about the availability of Dashers than they did a year ago. The company has also been able to lower incentives and promotions paid to Dashers. Remember last year, Doordash faced Dasher shortages driven by extreme weather and stimulus that was introduced during the pandemic. Dashers are the lifeblood of the company's business, so more Dashers means a stronger operation. Now, on a slightly more negative note, Doordash admitted that its convenience, non-restaurant segment is still going through a learning curve. It didn't completely take into account how different this business is from restaurants. Convenience store shopping requires Dashers to physically go into the stores and handpick items, and people tend to order just a few small things, like a bag of chips, a candy bar, and a soda, for example. So the order sizes tend to be lower too. Doordash stressed that the segment remains an enormous opportunity, but it's going to take some time to drive up the unit economics. Now, remember back in November, Doordash announced that it would acquire Finland-based food delivery company Wolt for 7 billion euros, or about $7.3 billion. The deal will expand Doordash's reach into Europe for the first time. Unfortunately, Doordash didn't really go into much detail prior to the deal closing, which is expected to happen in Q2. Overall, the Q1 numbers didn't blow me away, but they were generally solid, and the company's Q2 guidance was encouraging. I think investors may have wanted more positive news on the convenience segment. The stock has been heading lower since mid-November, when the Wolt deal was announced. Some skepticism seems to exist regarding whether Doordash is paying too much in this all-stock deal, or stretching itself too thin in an already competitive environment. The war in Ukraine is probably adding to jitters about the company increasing its exposure to Europe. Adding fuel to the downturn has been a general rotation out of tech in recent months as interest rates rise. I would hold back from going bottom fishing on Doordash right now and wait for the tech sector to begin to stabilize. What do you think about Doordash? Let me know in the comments below, as your comments help us all to better understand. Help us out by smashing that like button, sharing this video wherever you can, and join us in beating this market by clicking the first link in the description. I'd love to see you there. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.